Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz. Let's get across what we have seen develop on global markets overnight. Equities mostly positive as investors digested softer than expected US inflation and another day of strong earnings reports, while oil prices rose further as the US launched more strikes against Iran. On Wall Street, the major indices closed modestly higher. That's despite weakness in semiconductors, with solid bank earnings adding momentum to an impressive start to second quarter earnings season, and the bank results having been fueled by a surge in IPOs, mergers and debt issuance. Well, stocks specifically, Morgan Stanley beat quarterly profit expectations, posting record revenue driven by strong deals activity and $10 trillion in wealth management assets. And BlackRock, the world's largest money manager, saw its managed assets jump to a record $15.3 trillion in the quarter. Elsewhere, Johnson & Johnson's medical device unit underperformed in the second quarter, yet it still managed to beat Wall Street estimates, although shares fell. United Airlines expects full-year profit at the high end of its previous forecast as strong travel demand and higher fares help offset a renewed surge in fuel costs, even as third quarter earnings outlook there fell short of expectations. And outside of earnings results, PayPal shares surged 17%. On reports that Stripe and private equity firm Advent International have jointly offered to acquire it for $53 billion. And SpaceX shares dropped below their IPO price for the first time before closing just above that level, with investors increasingly concerned over debt-funded AI spending. Well, US producer prices unexpectedly fell in June, falling 0.3%. That's their largest decline in 14 months amid a pullback in the cost of energy. Further evidence that inflation was subsiding before the recent escalation in the Middle East conflict. Excluding food and energy, the core producer prices gained 0.2% after increasing 0.7% for 2 straight months. And the Fed's Beige Book of regional economic conditions showed US activity increased at a slight to moderate pace in recent weeks as most regions experienced little to no change in employment levels. And on the geopolitical front, US forces struck Iran's coastal defense and missile sites overnight after reimposing a naval blockade of its ports, while Iran threatened to shut off more regional energy exports, saying it was engaged in an existential war with America. Well, US Treasury yields fell following the latest inflation data, with the 2-year yield down to 4.12%, the 10-year was at 4.54%. Australian 3-year government bond yield futures fell to 4.46%, the 10-year at 4.91%. US dollar index down around 0.5%, the Aussie is back above 70 US cents. Oil prices have risen slightly more, tempered by stronger than expected inventories, while traders appear to ignore a new wave of US attacks against Iranian military installations that aim to limit Iran's ability to strike shipping in the Strait of Hormuz. Brent futures at close to around $85 a barrel. Gold broadly steady at around $4,060 an ounce. Copper futures a little changed, while iron ore rose almost 0.5% to 102 US a ton, and Bitcoin is currently trading below 65,000 US dollars. Let's get across what we're seeing with a focus on US markets at the moment. Joining us is Noah Weisberger, Chief US Equity Strategist at BCA Research. Noah, good to catch up with you. Thanks for joining us here at AusBiz for the first time. Fascinating time of what's going on in markets at the moment, with investors clearly focused on the beginning of earnings season there. We've got that inflation read as well, and also what is transpiring in the Middle East. Let's begin with what we've seen with earnings thus far, dominated by the big banks. What's your takeout been?
So, first off, thank you very much for having me. Good morning. Here's good evening. From the big banks, I think what we're seeing, we have a market neutral weight on the sector. We've seen some flattening in the yield curve, which is usually a headwind for the financial sector. But so far, what we've seen is a pretty solid quarter, some pretty solid beats. It's mostly coming from capital market activity, so the IPO market, M&A activity, trading activity, which sometimes isn't rewarded by investors as much because it tends to be somewhat cyclical and volatile. But there is some good signs on balance sheet strength, and we're also getting some pretty good read acrosses about consumer health, a little bit more mixed on the consumer health side, but overall a pretty solid picture. And I think it matches up a little bit with what the economic backdrop is, which is basically a low growth but steady economic backdrop. Interest rates kind of waxing and waning where we think interest rates end up given the shift we've seen recently in geopolitical tensions. Inflation seemed to have been easing, but maybe that comes out a little bit. And I think the financials are an important early quarter bellwether. The one last thing I'd say about them is while encouraging, they don't quite get to kind of the key risks that the market's focused on, which are namely how to continue to trade or how to continue to evaluate the AI trade. And that may actually be a good thing for the financial sector. They're a little bit removed from the biggest risk out there, or potentially the biggest driver as well.
Well, and in fact, no, I was mentioning that earlier there, particularly with SpaceX shares, as I said there, having dropped briefly below their IPO price, with investors certainly worried about the debt-funded AI spending we're seeing at the moment. Is there a little more clarity about that or not, do you think?
On the debt funding and on SpaceX more generally?
Well, on debt funding, I guess, in the AI space.
Yep. So I'd say two things. First, on SpaceX more narrowly, when we've looked at IPO performance and going back, 35, 40 years, many issues, many IPO offerings. The median IPO tends to do poorly over a 30-day, 1 year, and even 3 year period. So the fact that SpaceX is lagging a little bit here, there may be a SpaceX specific story, but the median IPO tends to not do all that well. The average IPO does quite well, meaning half the IPOs kind of do poorly, but there's some really strong performers. So if you just gave me the SpaceX numbers in and of themselves, I don't know that I'd be making a bigger story of it than typically IPOs sometimes struggle. They're priced to perfection when they come to the market. That said, I think the CapEx story and the market's willingness to see CapEx continue to rise is really critical. We've seen the semis do really well, and the hyperscalers kind of lag. That said, there doesn't seem to be an obvious leverage problem within the corporate sector. It seems to be that there's enough earning strength to take down that CapEx, and we do still think that there's a path for positive ROE and ROI for many of these hyperscalers. So I think that's the market's worry du jour. I think ultimately the strength of demand and the earnings growth should make that problem manageable. There may be episodic worries, and if you're kind of on the wrong end of that earnings growth versus debt growth balance, I think that may be a part of the market that is more vulnerable.
No, just picking up with what you had to say there, with clearly the focus being on semis having done very well, the hyperscalers lagging. Are you seeing an opportunity there with the hyperscalers?
Yeah, and some of my colleagues have made this explicit a rotation. I think we're leaning in that direction, although we haven't made that call explicitly. When you look at both software, which is a part of the market that I've liked for a while, and we've traded it tactically prior to Q1 earnings season through Q1, and we took off the trade. It doesn't seem to have legs. It seems to be tactical in nature. But I think when you look at valuations and you look at forward earnings estimates, hyperscalers are actually kind of on the cheap end, and software for sure. And so, one of the luxuries of having a diversified large cap portfolio or sector allocation is that these timing issues, you can kind of, own all the risks at once. But if I had to lean in or out, I would probably lean out of semis and lean more into some of the lagging parts of the market. You do face risks, right? The semis are facing, are benefiting from demand strength and supply constraints, and that's really boosted their earnings. But we do think that the hyperscalers and the software stocks still have solid earnings growth, and you're paying a much lower multiple for them. So it's funny to think of those as cheaper, but they are the cheaper part of the technology complex right now.
No, beyond AI and tech and also the banks, this earnings season, any other sectors you're focused on in particular? I may steer you towards energy, given obviously what is transpiring in the Middle East at the moment.
Yeah, so a couple of comments there. The first is we've seen a really interesting shift in June and July. We called it the June swoon versus the previous, let's say, 12 months or 6 months, where in the previous 12 months, the market was really focused on rewarding fundamentals. So if you were a sector with strong earnings growth, if you were a sector with strong revenues growth, you outperformed other sectors. That kind of broke apart in June. It broke apart because healthcare rallied and financials rallied. I think financials are maybe in part validating that a little bit. But to me, there's been a rotation because of the uncertainty around the bond market and energy prices and inflation. I think that's been a bit of a rotation. I'm not ready to give up on the AI theme or tech as the true driver of this economy. I just think we've been through a 4 or 6 week patch where there's been a bit of rebalancing and reallocation. Looking forward, I'm not particularly tempted by energy because I think it ultimately is just going to be too tied to geopolitical events that just wax and wane. We put on, I would say, uh, a derivative to that trade maybe 4 or 5 weeks ago. We got long consumer discretionary sector in the U.S. Uh, really focused not on the big names on Tesla and on Amazon, but really more on the retail and on the average U.S. consumer. Given that oil prices were falling, that the labor market was firming, we took that trade off a couple of days ago as concerns in the Mideast have re-intensified. So to me, energy is too tied to the to the geopolitical cycle. I will say the equity market up until now has been pretty disciplined in pricing those risks. And so initially, obviously, the indexes fell, but we have a gauge of the equity market's inflation view. So a long short basket that's meant to isolate inflation. And it did trade higher, meaning inflation sensitive parts of the market suffered when energy prices first started to move higher in the initial phases of the Gulf War. But I would say for the last 8 or 10 weeks, we've seen the equity market basically ignore an increase in headline inflation. I would have been arguing that it'll similarly ignore a decline in headline inflation, seeing through that transitory nature. I think if the market gets nervous, we might see that inflation risk factor start to outperform again, and that would be driven higher by the energy stocks. But that's not a part of the market I'm willing to stick my neck out. That said, we are overweight and we are long materials as a sector, both as a strategic trade and as a tactical trade. And I think there you benefit either from the improving cycle, which I think we have, and not either, and from their AI and old economy picks and shovels exposure. And also, if there are commodity side constraints because of geopolitical tensions, I think that should benefit that part of the market as well. Chinese weakness doesn't help, but if I had to pick a version of that kind of old economy exposure, I would do through materials, not through energy.
Just very briefly, almost out of time, Noah, but we did hear yesterday Jamie Dimon, JP Morgan chief, saying maybe this is as good as it gets. I mean, clearly talking about the banks there. Nonetheless, is there a risk there going forward, particularly, I guess, with potentially rising interest rates and how that's likely to affect earnings?
Yeah, it's hard to imagine a better scenario, even with a conflict in the Mideast over the last several months, right? If we go back to where we were in January, February, the U.S. economy seemed to be slowing, the labor market was moribund, and that seemed to be the market we were emerging into. We've seen the economy reaccelerate. I think the Fed is more neutral now. I think I was very concerned about sort of the political ramifications of a new Fed chairman. I think all of those have been put to rest. I think this is a dyed-in-the-wool central banker. As good as it gets, I struggle for what the new great news is. Meaning, if Q1 was so fantastic in terms of earnings, if we repeat that in Q2, I don't know if that's enough to get this market to keep going. What is the wall of worry that we climb? I still think at the end of the day, earnings strength is what propels this market. Over the medium term, S&P 500 returns are a combination of a multiple and earnings growth. Even if the multiple kind of has a pause here or faces some interest rate pressure, earnings growth is strong enough, I think, to continue to generate positive returns at least through year end.
Noah, terrific to get across your view of what you're seeing in markets at the moment. Thanks so much for joining us on BCA Research.
Great. Have a great day, and thanks for hosting me.
Thanks, Noah. All right, let's turn our attention to the local market just ahead of the open here. Looking for another positive start there, up around 15 points. We're going to get a number of corporate updates too, including more in the resources sector. Stay with us. The open is just around the corner.